All right, whole life insurance policies and product selection. What product should you choose? I wish I would have seen that before I started a policy. We often hear that when we're talking about the next product, the HECV, which stands for High Early Cash Value Product. This is a whole life insurance policy, which is unlike many other policies in respect to the early cash value. What you will find as we start to look at the numbers and go through the details on how this policy functions is we've got the premium and PUA piece, but you're going to see a bulk of the premium actually show up in cash value right off the bat, in addition to PUAs. This is very attractive for business owners, some high net worth individuals like these type of products where they really view a whole life insurance policy as a great area to store cash, a safe, fixed asset that grows over time, the death benefits there too, but they do not, under any circumstances, want to see a negative hit right off the bat. It just doesn't work for them. So of course we like to show all of the options and it's ultimately up to the consumer, but this is a great option to see. And I tell you what, a lot of people we work with don't select this when seeing it. But when people find out about it after the fact, meaning they went with a traditional policy or a different option, but then they see, wait a minute, I was never shown a high early cash value policy. I may have considered that. That creates that issue and sometimes a level of distrust, and this is just from experience, happens a lot in a lot of industries, the topic I'm hitting on here, but it causes problems when someone feels like, hey, I should have been shown that initially because that is interesting, especially when I'm told, how do I get more cash value up front? This is an option that provides that. So we're gonna break this up. I'm gonna go through a traditional high early cash value product in this video. And in the next video, we're gonna touch on a different type, executive strategies, which is a whole life insurance product as well, but that is specifically geared for corporations, businesses, high net worth individuals, functions a little bit differently. So I'm gonna give it its own video. A basic high early cash value product. How it works is you, the policyholder, can choose where your money goes, just like a traditional policy or any whole life insurance policy for that matter. Money that is directed toward the premium piece. Do you remember how that works with a traditional policy if you saw that video? Nothing shows up right off the bat. With a high early cash value product, you will typically see right around 80% of the base premium alone, show up in cash value in the first year. Now this does depend on when you purchased the product. What I'm referring to here is all new policies after the 7702 change. So if you have a guaranteed rate that is less than 4%, you'll likely see this. I'm specifically talking about Mass Mutual's high early cash value product as well. If you purchased a high early cash value product that has a guaranteed rate of 4%, then you'll see that closer to 90%. So it is important with respect to the timing on when we made that purchase, but I do want to be clear there and not cause any confusion if you already have a whole life insurance policy or if you saw one a while back. So you do get a death benefit that's purchased, but 80% right off the bat. PUA dollars function the same in a high early cash value product as they do with a traditional policy, show up in cash value, begin to compound, I can access it, all the fun stuff, the reason why so many people like whole life insurance. But kind of seems like a win-win right off the bat, where I get the bulk of my premium payment and PUAs on top of it. I'm gonna have over 90% cash value if I do everything properly here. I'll show you in a minute. Here's what I wanna add though. The advantage is the upfront cash value. That's what attracts people, that's the sizzle. What people don't like about it, because there's always give and take with all products, insurance companies know how to make their money, is when you look at the long-term performance. With a traditional policy, going back to the last video, the company is overcharging us for the premium in the first and second year, specifically with traditional. With a high early cash value product, they are not overcharging us for the cost of insurance in the first 2 years. They're charging us actually a higher rate, but it's spread out over the life of the policy. This is often why when we compare high early cash value products to almost every other whole life insurance policy out there, you'll see among the weakest long-term performance. Sometimes it does outperform traditional, depends on my age and funding circumstances, but often it's kind of in the name, high early cash value, not so great long-term cash value. But it depends on what your purpose is for using whole life insurance. let's look at some numbers here that kind of line up with this. So here's the point of attraction of the base premium, the piece that everyone hates. I get that in cash value right off the bat. So here we go. Name of the product. You'll see it in the top right, high early cash value. Okay. This is, again, a basic policy, $10,000 base premium, nothing fancy, no riders, no PUAs, everything directed toward the premium, $10,000. So here's your payment, $10,000 per year. Basic policy cash value end year. What this column represents is if you only paid the base premium, which is all that's on this policy, all that's on this illustration, but if you only paid the base premium, this column will never reflect any PUAs, term riders, nothing like that, and the company only paid the guaranteed rate, which in this example, the guaranteed rate is 3%. So what do you notice here? Year one, you pay in $10,000, you've got $79.61, just about 80%. If you were to look at the non-guaranteed cash values, what do you notice here? Total cash value, it's identical, exact same thing. If I look at time, or look at the numbers as time passes, when's your break even? So with 100% base premium, really between years 9 and 10. Year 10, I've paid in 100 grand. I have 99.5. Year 11, I've paid in 110. I've got 110.5. Not that attractive. Some people do like this. They say, hey, here's an area that in some cases cost me less than term insurance because I've got the life insurance and I do start to see some appreciation in the cash value. And that's with more of just a traditional life insurance sale, from a traditional life insurance sale standpoint. If your interest is maximum cash value, so going back to the whiteboard here, and you said, hey, I don't want to pay in 10 grand. I'm interested in a cash value life insurance policy because it's safe, it's liquid, and it's also tax-free if I don't trigger a MEC. I want to pay in, let's use the same numbers we did in the last example, $100,000 per year. So that's your number. How would we design this? Well, just like any other policy, what are the limits that exist? I'm going to set this at 10,000 and have the ability to throw another 90,000 in. Keep in mind I said ability, not commitment there. And then we'll set that MEC limit at, guess what? $100,000. Sometimes we'll overinflate this a bit when we MEC test a policy to make sure we don't run into an issue long term. But same design. Now, this design right here, if you're interested in this kind of policy, I would always, always ask for it. It is not shown that often to consumers, high cash value products in general. The main reason why is when you look at the compensation, it's much less upfront. Upfront is the key word. Products actually pay agents more over a long period of time, how the compensation structure works, but upfront it is very, very low compared to other products. So naturally, just from a sales tactic standpoint, I hear don't even show that option. Now, some agents do show it, and a lot of times it might not even be in your best interest when you look at it, so an agent might not show it for that reason. It's not a shot at any agents, but just from a consumer perspective, I'm playing the role of being the consumer. If I knew about it and it wasn't shown to me, I would ask because I want to see it and compare it to everything else for myself, and I specifically want to compare the design to make sure that it's a true apples to apples comparison and things are not being manipulated. So we've got the traditional policy here, all base premium. Let's blend this guy and look at a high cash value, high early cash value product. All right, so what we've got here from a design standpoint, where's the money going? Same thing, oopsie daisy, there we go. Premium piece, all right. Identical, $10,000. This column again, I'm gonna keep on hitting this because these columns can be confusing. What does this column represent? Base premium only, base only, which in this case is the 10K, and the guaranteed rate only of 3%. 79.61. Year 5, 38,723. Your total payment's 100K per year. That's what this column shows. Let's go back to this guy. What do you notice here? All 10 or only 10K, 79.61, 38,723. Identical, because that is based on the base premium only. Let's go back. Okay, so here's our values. So I mentioned earlier, if you do things right, you'll have over 90% right off the bat of your payment and cash value. That is a point of attraction to many people. So here, we've got $100,000 that goes in. Right off the bat, $92,000. Now, I will emphasize that this will be, if this was your policy, you would see this at the end of the first policy year, not right off the bat. When I make a payment to a life insurance company, like MassMutual in this case, typically start out with a little bit less. My online portal shows an overinflated amount, which that's an IT issue, but starts out with less, and then over the course of the year, I see it accumulate, and then it hits whatever the illustration reads, and illustrations are most accurate year to year. We always want to look at an in-force illustration. That's something we track for everyone we work with. I like to make sure it matches up to the dollar, to the penny. It's very important. And if it doesn't, we go and question it. But that's a good conversation for another time. So here's the payments. When'd you break even? Paying in $100K per year. So by year 4, you've paid in a total of what? $400,000. By year 5, you've paid in a total of $500,000. You've got $505,000. So your break even is really between years 4 and 5. Call it 4.5, just for the sake of having fun. Now this is an example where we can continue to pay into it. How long we can make payments depends on the company. This particular product allows you to pay into it up until the age of 85. So that's a long time, to be frank. MEC limit, overinflated a little bit, 113, but there we go, funding it for 25 years. So let's take a look at this guy and also the guaranteed values, because remember, this product has a guaranteed rate of 3%. If you recall the traditional video, it's 3.75 with Mass and 3% with Guardian, as all companies get to choose their guaranteed rates now. So here we go, high early cash value product. Based on the guarantees, what do you notice here? Year 1, so absolute worst case scenario, $90,000 right off the bat. No matter how you slice it, it's a negative 10% hit. So MassMutual, if you were to Google search their 2022 dividend interest rate, what would you find? 6% flat, okay? So that's their actual dividend rate. What I like to emphasize here is the dividend is not what you are earning on your money. So important to emphasize that. I feel like I shouldn't have to, but it's important because people get confused and frustrated over this. Year 1, I paid $100,000. I have $90,000. Which is about a 10% negative internal rate of return. It's a hit on my money. Here I go. Annual IRR isolates what I'm earning year over year. And then the average says, hey, over 10 years, in this example, 100K for only 5 years. I've paid in a total of $500,000. Average IRR is just over 0.1%. Not that attractive there in that respect. Then I've got the 5-pay over here based on the current dividend values. When did I break even on that 25-year fund? Based on the illustration, between years 4 and 5. Same exact thing here. In fact, I skipped to the 5-year by accident. Here's really where I meant to start. Apologies. There's the guy that matches the illustration. So first year, got that negative hit. There we go. Continue to pump money in. Internal rate of return, annual and average. Dividends, guarantees. I like to see both side by side. Break even and all that good stuff. The break even here is actually not between years 6 and 7. That is a color error on my end. Let's fix that up. Really between years 11 and 12. Okay, perfect. So this guy represents what? Funding it for 25 years. You've got the guaranteed values compared to the non-guaranteed values. It's always good to see both side by side from the consumer's perspective. Then, what if life happens, or what if you really like this policy, but you deliberately approach it with only 5 years in mind? A lot of people do this, where they say, hey, I've got $500,000, I'm comfortable moving $100,000 per year into a whole life insurance policy, and then I'm done. But I might want to keep going. Maybe I had 100, maybe I had 10, I can add any amount I want. You can do that in this case. So here, what do you notice? 100 in, 92% right off the bat. There's the negative IRR. There's your crossover. You'll notice your average IRR is no longer in the red when you break even, when you have more money in cash value than what you've paid in. That's when your average internal rate of return is in the black. And then it continues to accrue over time, which is exactly what I want. So the high early cash value product, that is a great option if you really like the idea of seeing or having your money up front. The drawback to it is that the insurance expenses are a bit higher. They're spread out over the life of the policy. So when you compare things guaranteed and non-guaranteed to other products, it does lag a little bit. But again, it's all up to the individual and why you are using the policy. It's up to you. As long as you have full transparency, that's where you prevent any chance of buyer's remorse. So I hope you enjoyed this video. I did quite a bit. In the next one, we're going to look at the Executive Strategies product. That'll be a lot of fun. If you enjoyed, hit that like button. Please subscribe for more, and we'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.